Hello and welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of Omnicom Group Inc., ticker symbol OMC. So we're looking at Omnicom today as a subscriber request. Currently, the business is trading for $83.78 per share, and over the past year, their stock price is up nearly 9%. Which is in stark contrast to the S&P 500, which is down over this period. So we want to analyze Omnicom today to understand what are we missing? What could the market have possibly discovered about this business this past year that's led to this kind of outperformance? Over the last 5 years, Omnicom is only up 11% overall, so their stock price is compounding at 2% annually. The business has just under doubled from its lows in October of 2020. Over 10 years, Omnicom is compounding at a rate of 4.5% annually. And going back prior to the global financial crisis, over the last nearly 18 years, Omnicom is compounding at a rate of 4% annually. Keep in mind that they do pay out dividends and that their average dividend yield over this time frame would be in addition to these compounded annual returns. Right now, Omnicom is paying out an above average dividend yield of nearly 3.3%, which is about double that of the yield of an S&P 500 ETF. So Omnicom is down $8 from their 52-week high. They're up more than $20 from their 52-week low. A little under 5% of their shares outstanding are currently sold short, and they're a large business. They have about a $17 billion market cap. So for additional background about the business, Omnicom is the world's second largest ad holding company based on annual revenue. The firm's services, which include traditional and digital advertising and public relations, are provided worldwide with over 85% of its revenue coming from more developed regions such as North America and Europe. So in that regard, it's very similar to its peer Interpublic Group. Omnicom was incorporated in 1944 and is based in the Big Apple, New York, New York. So for our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of Omnicom based off of their business fundamentals. So this analysis is still a work in progress, and it's an opportunity to learn in public, so it will continue to improve and get better over time. With that said, let's get right into today's analysis. So starting things off with metric number 1, we want their average return on capital over the past 5 years to be above 14%. And there are 2 key reasons for this. The first is that the average publicly listed business earns about a 7% return on capital. And the second is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns. And these business returns are going to be captured here by return on capital. So by asking for a benchmark of 14% or higher, we can potentially build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. Omnicom has earned significantly above average returns on capital in all 5 of these years. The lowest returns they earned were in fiscal 2020 when they had 15% returns on capital, and since the COVID-19 pandemic lockdowns, the business's returns on capital have been improving. They produced about 20% returns on capital over their last 12 months, and averaged out over these past 5 fiscal years, Omnicom is also producing about a 20% average return on capital. That's nearly 3 times better than that of a typical business, and that's strongly above the 14% benchmark we're looking for. So this is a check to start things off here on metric number 1 for Omnicom. Next up, for metric number 2, here we're taking a high-level overview of the growth of their business. So we're looking for revenue, net income, and free cash flow growth over the last 5 years. And this metric is all or nothing in nature. Either all 3 of these are going to be up for this to be a check, or if even one of these is down, this entire metric will be an X. We'll also be including their last 12 months worth of numbers in our calculations here. So over this time, Omnicom has seen their revenues decline slightly, so they're down about 7%. At the same time, their earnings are up a modest 18%, but the real kicker here is that their free cash flows have declined by 59%, so they're down significantly over their last 12 months from where they were at, especially compared to 2017. And looking at their cash flow statement, we can see that a lot of that came from significant capital expenditures in what's otherwise been a pretty asset-like business. So that's something that you would want to dig into and understand this CapEx spend in more depth, whether or not they were doing this because they had been deferring the maintenance CapEx that they should have been investing over this time, or if this is going to be growth CapEx spending. Either way, though, it does impact their free cash flows currently. And so their free cash flows are down. So between their revenue and their free cash flow declines over this time frame, this is an X on metric number 2 for Omnicom. Next up, for metric number 3, here we're taking the perspective of an individual shareholder in Omnicom by looking for earnings per share growth over the past 5 years. So we're looking at the company on a per share basis here. We learned that over this time frame in the previous metric that they've grown their earnings by 18%. At the same time, Omnicom has bought back 11% of their shares outstanding, which is likely a strong sign for long-term shareholders in the business, because when you purchase a share of stock, what you're really buying is a fractional ownership percentage in that company. And so when a business buys back stock by decreasing the amount of shares that they have outstanding, They're increasing your ownership percentage in the business, which is ultimately going to increase the percentage of the business's profits that you're entitled to without you having to spend a dime. So it's almost as if the company is making a partial acquisition of itself. And so just like with any other acquisition, we want the company to be getting more value than the price that they're paying. You can look at their filings to understand at exactly what prices they were buying back these shares. But again, between a lower share count and higher earnings, this is strong earnings per share growth for Omnicom. And this is a check here on metric number 3. In metric number 4, we're looking for something similar. So here we're looking for free cash flow per share growth over the past 5 years. Again, with their free cash flows declining because of this additional CapEx spending, that's going to outpace their share buybacks over this time frame. So their free cash flows per share are down over this period, meaning that this is an X on metric number 4. Omnicom has produced $3.69 worth of free cash flow per share over their last 12 months. But again, this is down. So far through our first 4 metrics, we're split evenly on Omnicom, 2 checks and 2 X's. Next up, for metric number 5, here we're evaluating how the business is utilizing debt. So we don't want to be investing in overly levered businesses because during economic downturns, it's overly levered businesses that are going to be at the greatest risk of poor outcomes. So we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow that the business has produced over the last 5 years. So Omnicom ended 2021 with $1.7 billion worth of net debt. Since then, they've added on to this, and currently they have the most net debt that they've had in any of these previous 5 years. They have about $3.1 billion worth of net debt. However, over this time frame, the company has produced more than $8.1 billion worth of free cash flow, so that's more than enough to be able to comfortably support this debt load. Even with their declining free cash flows because of that high CapEx spend, if we were to extrapolate their current free cash flows out over the next 5 years, it looks like they'd still be able to comfortably support their net debt position. So in comparison to their abilities to produce free cash flows, it looks like Omnicare is using a reasonable amount of leverage in their business. So this is a check here on metric number 5. Then our 6th and final metric, the big metric of them all, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this will potentially give us a slight risk premium in comparison to the yield of the 10-year treasury and potentially offer us a reasonable starting point for evaluation of Omnicom. So we're using their total enterprise value because it takes into account both their market cap and their net debt position, and it's going to give us a perspective of the business that's more similar to as if Omnicom were a private company. So currently, Omnicom has a $21 billion total enterprise value, and we learned that over their last 5 years, the company has produced $8.1 billion worth of free cash flow, meaning that in an average year, Omnicom produces about $1.6 billion worth of free cash flow. So when we divide their $1.6 billion of their average free cash flow by their $21 billion total enterprise value, that gives us about a 7.6% average free cash flow to enterprise value yield for the company, which is above that 5% risk premium we're ideally seeking, and that's more than double the yield of the 10-year treasury currently. So on an average basis of their historical free cash flows, this is a check here on metric number 6 for Omnicom. Worth being aware of though, because their free cash flows are down over their last 12 months, when we divide their $767 million of their last 12 months of free cash flow by their $21 billion total enterprise value, we're only getting a 3.7% current free cash flow to enterprise value yield for the business. So that's right about in line with the yield of the 10-year treasury, but that's below that 5% risk premium that we're ideally seeking. Again, though, it's really crucial to dig in and learn more about the business to make this distinction of whether this CapEx was for maintenance or for growth for the business, as Omnicom tends to be a very capital-light business by its nature. So while we are split on an average in a current basis, it's likely that the economic reality for the company lies somewhere between the two. But because this is a check, it still means that Omnicom is potentially an interesting business to dig in and learn more about. While this is not a buy or sell recommendation of any security, just because this is a check here, it could be worth your while to dig in and learn more about the business. Keep in mind that this is just one of our 6 metrics, and this analysis is holistic in nature. So even though these metrics are simple, when they're combined together, they can be quite powerful. And we've still got some interesting things to learn about the business moving forward. So then here as a bonus, we're taking a look at Omnicom's dividend profile. So Omnicom is currently paying out an above average 3.3% dividend yield. However, it's important to stop and look at the underlying fundamentals of a business to determine whether or not that company is able to comfortably support their dividends with either their cash flows or their earnings, depending on the type of business. So for Omnicom, we want their dividends to be well supported by their free cash flows, and that looks like that's been the case over all 5 of these previous fiscal years, and that's also been the case over their last 12 months as well. While they've modestly grown their dividend payouts over this time, they've also reduced their shares outstanding, and at the same time, even though their free cash flows have come down, they still maintain maintained a pretty reasonable dividend payout ratio, and they have a pretty healthy margin between the free cash flows that they're bringing in and the dividends that they're paying out. Coupling this with a reasonable debt position for the business, it looks like Omnicare's dividend should be in good shape moving forward, although it is worth noting that advertising can be a cyclical industry, and that during recessionary times, advertising is likely one of the first cuts that businesses will make. However, that makes up for itself in more expansive economic cycles, as advertising is likely one of the first industries to start rebounding on the other side of a potential economic contraction or recession. And given the asset-light nature of the business and the high returns on capital that the company is able to earn, in addition to its strong abilities to produce free cash flows, this likely isn't that much of a concern for a long-term shareholder in the company. Then everything that we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Omnicom, which takes us on to using a discounted cash flow model to come to a potential fair value for the business. So a discounted cash flow model is just like any other model in any other discipline. Its outputs are going to be sensitive to its inputs. So here we're starting with an average of their free cash flows over their last 5 years. Then we're using historical growth assumptions for how Omnicom has grown their free cash flows over the past 20 years to give us a baseline projected estimate for how Omnicom could potentially fare over the next 20 years. So it's up to you to do your own homework here to determine whether or not these historical growth assumptions are going to be accurate and applicable going forward for Omnicom. So if we assume that they grow their average free cash flows at a rate of 6.25% annually for the next 10 years, then we use a terminal stage for the 10 years out after that, where this growth rate slows down to 4% annually. We're not going to be adding in their tangible book value because that's skewed based off how the accounting is done for their share buybacks. But if we were seeking a potential 15% rate of return for Omnicom, which is the rate of return that Warren Buffett is ideally seeking from his investments, then it looks like with today's valuation multiples of the company, that a fair value for Omnicom is right around $53.50 per share, which is down about $30 from the business's current stock price. Please keep in mind a couple of caveats here. One is that this discount rate would be including their dividend yield, so we would not be doubly counting dividends. And then two, a discounted cash flow model really depends on the predictability of a business's abilities to produce free cash flows. It's really important to be looking at businesses that are well within your circle of competence and that you've done the work on to understand how they're likely to fare into the future. So then please be mindful of the fact that this type of analysis is not financial advice. It's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. In just a minute, we'll talk about our recap for Omnicom, but we have to address something first. What are some of the qualitative aspects of this business, especially those around the key points for a potential long or a potential short thesis of Omnicom? So starting with some of the key points around a potential long thesis for the business, number one, the strength of Omnicom's 3 major global networks allows the firm to retain even dissatisfied clients by switching them from one award-winning network to another. 2, Omnicom's agencies such as BBDO and DDB are some of the most acclaimed in the business. And 3, Omnicom's management team is very experienced and has delivered solid results over an extended period through a variety of economic environments. Then for some of the key points around a potential short thesis for the business. Number 1, growth could be a challenge after several years of strong sales growth. Aside from slight market share wins, the bulk of top-line growth comes from the level of corporate spending on advertising and marketing. Number 2, the company could overreach for growth in international markets and overpay for acquisitions. And number 3, marketers are increasingly asking for better results from their agencies while heavily scrutinizing the fees that they're paying. This trend will only continue as alternative marketing channels gain adoption with users. So hopefully that offers a potentially balanced perspective around some of the key qualitative aspects of Omnicom. Now it's time for a wrap-up. So in summary, Omnicom checks the box on 4 out of 6 of our metrics. They're earning average returns on capital of about 20%, and those have been pretty steady for most of the past 5 years. That's also where they're at over their last 12 months. Then, while the business's earnings are up over the past 5 years, their revenues are slightly down and their free cash flows are down. Again, their free cash flows are mainly down because of higher capex over their last 12 months. So it's really worthwhile to dig into the company's filings and try to understand if this capex was for maintenance or for growth purposes, as Omnicom operates a pretty traditionally asset-light business model. Then over this period, the business has also bought back 11% of their shares outstanding. And even though they've tacked on some debt over the past year, on both an average and a current basis of their free cash flows, it looks like the company would very easily be able to support this debt load. When we look at their average and their current free cash flows to their enterprise value and compare that to the yield of the 10-year treasury, it looks like on an average basis, that would be giving us a potential attractive risk premium. However, their current free cash flow to enterprise value yield is just about in line with the yield of the 10-year treasury. So the reality for the company is likely somewhere in between the two. However, again, their current free cash flows are brought down by their capex. Then looking at their dividend profile, it looks like Omnicom has been able to healthily support a pretty modest dividend payout ratio in all 5 of their previous fiscal years, and that's also been the case over their last 12 months as well. It also helps that the company is paying out an above average 3.3% dividend yield. Then finally, performing a discounted cash flow analysis of Omnicom Group. If you've done the work and you believe that those historical growth assumptions are going to be potentially accurate and applicable going forward for the business, that if you were ideally seeking a 15% rate of return for Omnicom over the next 20 years from today's valuation multiples, that a reasonable fair value for Omnicom is about $53.50 per share. The company was last around that mark in October of 2020, so it is possible for the business to get there. You would just want to be patient. And just like with any other business, a discounted cash flow model is really going to depend on the predictability of a business's ability to produce free cash flows out into the future. So you would want to make sure that Omnicom is squarely within your circle of competence and that you're getting an appropriate margin of safety on top of that required rate of return. As mentioned, advertising and marketing tends to be one of the first things that businesses cut going into potential recessionary times. However, advertising and marketing spend tends to pick up more quickly on the upside coming out of a potential recession, so things end up balancing out for the business over the long run. So again, with some of those caveats and with the fact that this 15% rate of return would be drastically outperforming how the business has performed over their past 2 decades or so, it's worth reiterating that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with your financial advisor. This analysis instead serves as a beginning and holistic understanding to help you determine whether it's worth your time and energy to dig in and learn more about Omnicom. One resource that will definitely help you stay up to speed with what's going on in the market and help you learn more about the business is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community-written articles on different stocks. But over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's algorithm. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts for when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years of financial data on any stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $119. That's just 33 cents per day through my referral link down in the description below. Normally premium is $239, but if you use my link, it's 50% off. So check it out if you're interested. So as a value investor, you're ultimately trying to conduct this research as if you're going to own 100% of the business, and you can truly understand its underlying essence and understand what's important and what's not important for Omnicom going forward. So through this deeper research, you'll learn more about the qualitative and the quantitative aspects of Omnicom, and you'll likely be able to determine for yourself what a reasonably appropriate intrinsic value for the company will be. So with that said, that's it for today's fundamental stock analysis of Omnicom Group Inc., ticker symbol OMC. Again, we looked at the business today as a subscriber request, and because we looked at Interpublic Group, one of Omnicom's major competitors, last week. So I'm happy to make an analysis of the company. And if you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Omnicom with me, and have a great day.